How great was it to have the 2019 rally into new highs? Remember those all-time highs on the S&P 500 and the Nasdaq at the end of April? It was great, wasn't it? No? It was fake? Now why would you say such a thing? Well, let's take a deeper look. Let's look at the internals. Let's go X-ray vision. If we take a real close look, on an equal weight basis, the 2019 rally was the weakest of the last three rallies, and by far. In order to take a look at the last three rallies, we need to focus on the $ XVG. And that is a symbol that works only on some charts, so don't be surprised if it doesn't work on your chart. And that is the value line geometric index. The geometric index tracks the median moves of its components using the assumption that each stock in the index has an equal amount of weighting invested in each stock. The daily average moves of stocks are then calculated geometrically rather than arithmetically. In other words, the value line geometric index eliminates the illusion created by cap-weighted index components, where heavily weighted stocks within a cap-weighted index can pull it higher, even if the majority of the stocks within the index are not pulling higher themselves. As an example, in a cap-weighted index like the S&P 500, it is possible for the top 100 weighted stocks in the index to carry the index higher, while the remaining 400 stocks could lose value all at the same time. As an investor, it provides helpful insight to be able to identify when this circumstance may be happening. Well, looking at the recent rally that started in December of 2018, it just happened, and in a very eventful way. Looking at this chart here, you can see that the stock moves from June of 2017 to the present. In the top portion of the chart is the Relative Strength Index, or the RSI. The RSI is weakening, as shown by the declining yellow line, as the stock market reaches the peak in the last three circumstances. The middle portion of the chart, in blue, is the XVG reading, also shown the last three market peaks. The bottom portion of the chart shows the S&P 500 in red. Based on the 2019 readings compared to the 2018 readings, the chart clearly shows the deterioration of the fundamental strength in the market. So, then the implication is that the broader market of companies did not follow some of the big cap names to new highs. And now that the indices have fallen below the 2018 highs, the underperformance is more apparent. And as this chart shows here, there have been mostly negative returns since the January 2018 highs. Only the tech sector has risen. All of the remaining sectors are below their 2018 highs. I'm pointing this out to all of you because we have seen this characteristic before. And as you can see in this chart here, the market highs in autumn of 2007 came with a weakening XVG. We know that new market highs on the weakening equal weight basis have also been experienced with previous major tops, such as in the year 2000. At that time, investors jumped into select winners and ignored the message of the weakening larger market breadth. And although I do not believe that at this time we are nearing a market crash, I do believe the fundamentals of the market are not as strong as they first appear. And this is simply a cautionary flag that you should be aware of if you make any decisions in the market. So just be careful and patient. So for today, that's ChewDog Charts. Thank you.